Hi everyone, and welcome to our channel. I'm Daniel Lader, CPA and founder of Lader CPA and Associates, where we help mental health professionals build thriving private practices with smart financial strategies. Today, I'm diving into one of my favorite topics, tax strategies. But not the vague, write off everything kind of advice that you might see on TikTok. I'm talking about real, proven strategies that help small business owners, especially therapists in private practice, keep more of what they earn. I break tax strategies into 5 categories. This framework helps make sense of what's available, what's legal, and what's actually useful depending on your situation. Let's jump into it. Let's start with the basics. Practical tax strategies. These are things you can start doing today. No special forms, no lawyers, just simple systems that create clarity and save you money. First up, bookkeeping. I know, boring, right? But if you don't track your expenses and income accurately, you're leaving money on the table. Good records mean more deductions you can confidently claim, less stress if you ever get audited, and faster decisions throughout the year. Use software like QuickBooks or Xero or Wave or whatever you'll consistently maintain. And categorize things properly. Therapy supplies, professional development, rent, utilities, mileage, it all adds up. Second, digital receipts and documentation. Don't wait until tax season to search for that lunch receipt from March. Use a receipt capture tool or just a Google Drive folder to snap photos and keep a log. Third, quarterly reviews. Every few months, look at your income, expenses, and how much you've paid in estimated taxes. This avoids surprises and gives you time to adjust. And finally, this one's a little bigger, setting up payroll. If you're paying yourself from your business, especially as an S corporation, you'll eventually need to run payroll. And it might sound intimidating, but it can be handled easily with payroll software or a bookkeeper. Once it's set up, it runs in the background and helps you stay compliant, especially with tax withholdings and retirement contributions. Now, let's talk about business structure. Choosing the right entity, whether you're a sole proprietor, LLC, S corporation, or something else, has a major impact on your taxes. Most therapists start as sole proprietors, which is fine at first, but as your income grows, forming an S corporation can save you thousands in self-employment tax. Why? Because as an S corporation, you can split your income into a reasonable salary, which is taxed for Social Security and Medicare, and a distribution, which avoids those payroll taxes. But here's the catch. You have to do it right. You'll need payroll processing, proper bookkeeping, and to file the S Corp election with the IRS, Form 2553. Not everyone should be an S corporation right away. If your net income is under around $80,000, the savings might not outweigh the costs and complexity. Let's also talk about hiring employees. When you start bringing on admin support or associate therapists, you'll need to shift how you think about taxes. Employees require payroll tax withholding, benefit planning, and possibly adjusting your business structure. But the good news is, it also opens up more tax advantage strategies, which we'll get into shortly. One more quick note, hiring your own kids. Yep, it's legit. If your kids do real work for your business, you can pay them, deduct the wages, and depending on how it's set up, that income might not be taxed for them at all. There are rules, of course, but done right, this is a powerful way to shift income to a lower tax bracket and teach your kids about money. The structure of your business should evolve with your income, your goals, and your team. Next, retirement savings vehicles. This is one of the best ways to reduce your taxable income while preparing for the future. If you're a business owner, you've got options beyond a traditional IRA or Roth IRA. Consider SEP IRAs. Simple to set up, lets you contribute up to 25% of your compensation with a cap of $70,000 in 2025. Simple IRAs, great if you have employees. Less admin than a 401k, with employee contribution limits of $16,500 in 2025, plus a $3,500 catch-up contribution if you're over 50 years old. A solo 401k, fantastic if it's just you or you and a spouse. In 2025, you can contribute up to $23,500 as an employee, with a total contribution limit for employee plus employer of $70,000. If you're 50 or older, you can add a catch-up contribution of $7,500. And if you're between 60 and 63, this part's odd, the catch-up contribution increases to $11,250. These contributions are tax deductible now, grow tax deferred, and offer serious long-term benefits. If you're not using a retirement plan, that's probably the biggest missed opportunity I see in small practices. Let's move to payroll and fringe benefits. This is where things get fun for us corporation owners. When you run payroll, you open up access to benefits that are both tax efficient and help you attract or retain staff. Examples include health insurance premiums paid by the business, HSA contributions, retirement plan matching, accountable plans to reimburse home office or travel costs. You can also provide tax-free employee benefits like education assistance, dependent care assistance, and commuter benefits. These aren't loopholes. They're incentives built into the tax code to encourage business owners to take care of themselves and their team. Just be sure to document everything and follow IRS rules. For example, if you're reimbursing yourself for your home office, you need to have a written policy in place. Finally, let's talk about investment strategies, ways to reduce or defer taxes while building long-term wealth. When most people hear investments, they think stocks or real estate. But in tax planning, we're looking at where your money goes after it's earned and how it's treated by the IRS. Traditional and Roth IRAs. Most folks are familiar with IRAs, but they're still underused by business owners. With a traditional IRA, you may be able to deduct your contributions now and pay taxes later when you withdraw in retirement. With a Roth IRA, you pay taxes now, but withdrawals in retirement are completely tax-free, including any investment growth. In 2025, the contribution limit is $7,000 or $8,000 if you're over 50. Even if you have a SEP, IRA, or solo 401k, you might still qualify to contribute to an IRA, depending on your income. Education savings account. If you've got kids or plan to, consider a 529 plan. Contributions grow tax-free, and withdrawals are tax-free when used for qualified education expenses. In 2025, you can contribute up to $19,000 per beneficiary without those funds counting against your lifetime gift tax exemption amount. But a 529 does not create a federal income tax deduction, but maybe a state tax deduction. Or a Coverdell ESA, a Coverdell education savings account, similar to a 529, but with more flexibility and lower contribution limits. This does create a federal tax deduction, but there are income limits on who can contribute. These offer long-term tax-free growth, especially when you start early. Real estate investments. Real estate offers several powerful tax advantages. Depreciation gives you a deduction for the wear and tear on the property, even if its value is rising. 1031 exchanges let you defer capital gains when you sell and reinvest in a similar property. And if you meet the qualifications for being a real estate professional, you can offset other income with rental losses, though that requires a lot of activity and documentation. Even owning your own office building can come with tax benefits, like depreciation and expense deductions. Health savings accounts, HSAs. If you're enrolled in a high deductible health plan, the HSA is a hidden gem. Contributions are tax deductible, growth is tax-free, withdrawals for medical expenses are tax-free. That's a triple tax benefit. In 2025, the contribution limits are $4,300 for individuals and $8,550 for families. And after 65, you can use it for anything, not just medical expenses. Just pay income tax like a traditional IRA for those withdrawals. Trusts and estate planning. Let's talk about trusts. These aren't just for ultra-wealthy people with generational wealth. A living trust helps avoid probate, make sure your assets go where you want them, keep your real estate matters private, more advanced strategies like irrevocable trusts or charitable remainder trusts can reduce estate taxes and even generate income. It's worth speaking with a financial advisor or estate attorney as your assets grow. So there you have it. 5 categories of tax strategies that every private practice owner should know. Practical systems, smart business structure, retirement savings tools, payroll and owner benefits, investments that reduce or defer taxes. If you found this helpful, hit that like button and subscribe to the channel. And if you're a mental health professional who wants help applying these strategies to your own practice, you can find me at latercpa.com. I'd be happy to chat with you. Thanks for watching, and I'll see you all on the next video.